Describe functions of a bond indenture and compare affirmative and negative covenants and identify examples of each. A bond indenture or a trust deed is the contractual agreement of a bond. This forms the basis for the agreement between the issuer and the holder to protect the interests of both parties. In this document, you will find information on all of the features we discussed in the previous section: the legal identity of the issuer, the par value, the maturity date, the coupon rate and frequency, the location of the issue, and the currency denomination. Along with those, we will see some details regarding the sources of funding, sources of collateral, credit enhancements, and covenants. Now, in terms of sources of funding, this is a section of the indenture where the issuer is expected to describe how they are going to service the debt. Now, obviously, this will depend completely on the issuer and the reason for the bond issue in the first place. With a sovereign bond, for example, a loan might be serviced through tax proceeds or from the money supply. With a corporation, the interest payments will be serviced by profits from ongoing operations or cash flow from a project. With securitization, we depend on cash flow from underlying assets to cover the repayments. This, of course, is one of the technical sources of the financial crash in 2007 to 2009, when the underlying home loans were being defaulted on, so there wasn't enough cash coming in to cover the obligations of the securitized issue. Under the title of collateral, we must first talk about the seniority of claims. Some bonds are secured in that the issuer offers some guarantee to the holder, meaning that in the event of a default, the bondholder will have a specific claim on certain assets. Some bonds, on the other hand, are unsecured, whereby the holder has no guarantee. The bondholder simply has a general claim on the overall assets of the issuing entity. This means that in the event of a default, the holder of an unsecured bond will have the right to claim their portion of the proceeds from a liquidation across all the assets of that issuer. Note that in the US, an unsecured bond is called a debenture, but in the UK, it's a bond that is secured by specific assets, which is called a debenture. Next, we must look at credit enhancements. An internal credit enhancement is where the structure of the deal or the value of collateral is of some benefit to the holder. Tranching or subordination is the most common technique, where certain bondholders are first in line to be paid when cash is available for interest payments. Another would be over-collateralization, whereby the collateral backing an issue is worth more than the issue itself, so the holders stand to gain if the issuer defaults. Now, before we move on, let's go into a bit more detail on subordination. Let's say, for example, that a company has issued debt so that they can fund a project. The cash flow from the project, which is received by the company, is intended to fund the coupon payments on the bond. Imagine that the cash flow from the project flows like water into this tank. As the project earns money, water starts to accumulate in the tank, but water also flows out from the bottom of the tank to represent the amount we are paying in coupon payments on the bond. When it comes to tranching, you can imagine that there are a number of different valves up the side of the tank, where each valve represents a different level of seniority. The most senior tranche gets paid when any water flows into the tank, but the least senior tranche, in this case tranche D, will only receive their coupon payment if the project cash flow is sufficient such that the amount of water in the tank reaches that valve. Moving on from internal credit enhancements, let's talk about an external credit enhancement. This is simply a guarantee from a third party. Finally, then, we must talk about covenants. Now, covenants can be split into two categories. Negative, which are covenants restricting the issuer from certain activities like taking on additional debt or selling assets which might be used in a liquidation on this debt issue. And affirmative, which require that the issuer perform certain activities like maintain a certain debt to equity ratio or comply with laws and regulation.